let's get started. So the cash secured put mechanics, okay? So essentially, as many of you know, options, basically people who buy options own rights. They own rights to either buy 100 shares of stock on or before expiration in the case of calls, or sell 100 shares of stock in the case of puts on or before expiration. Now, obviously, there's two sides to a trade. So for every buyer, there's a seller. Well, somebody who sells an option is selling that right to somebody who's buying it, okay? So by selling an option, you are now taking on the obligation to either deliver stock in the case of calls, if the call ever gets exercised, or take delivery of shares in the case of puts if the put exerciser decides to exercise. And in return for this obligation that you take on, you receive premium income in the case of, you know, whatever that call or put is trading for, okay? So typically somebody who sells puts is typically neutral to moderately bullish, or they have an expectation that implied volatility of the options might go lower, meaning that maybe the market's rolled over and implied volatility has gone higher, meaning that option prices have gone higher. So typically, like, you know, most things, people like to buy low, sell high, okay? So when implied volatility is low, people are generally more bigger buyers of options, and when implied volatility is high and option prices are expensive, they're bigger sellers of options, okay? So people who like to write puts typically are, once again, doing so because they're neutral to moderately bullish, and they're also looking for implied volatility levels to go lower. So keep in mind that when you sell a naked put or a cash secured put, your downside is you have downside if you ever get a sign on that put. In other words, if you get a sign on a short put, you are going to take delivery of those shares. You're going to pay your strike price times 100, take delivery of those shares, and you're going to have risk on those shares from your strike price all the way down to zero, less any income that you take in premium from the sale of that put. Okay, we'll get into more of that in a little bit, also known as the break-even price. But essentially, you have risk from your break-even price all the way down to zero. If a stock, you know, went bankrupt, you could lose your whole investment, which is basically the same risk that you would have if you bought stock, okay, which is what you're doing when you get a sign on a put. You're actually buying shares of stock. So typically, people will use cash secured puts as a creative way to potentially buy stock at a price lower than it's currently trading for, meaning that maybe stocks run from 80 to 100. I'm not comfortable chasing it. I don't